This is not good for risk assets. Wouldn't buy U.S. stocks. You agree?
Well, I think avoiding the entire U.S. market may not make a lot of sense, but I think you have to be way up in quality. You know, we've had some fits and starts this year, particularly in January, where you saw kind of speculative juices kick back in and provide fill-up to areas like the meme stocks and early cyclicals. I think this is an environment where you want to stay factor-focused and really high-quality factors. So high interest coverage and strong balance sheet and strong free cash flow, low volatility. I think that's the way to navigate within a still uncertain equity market versus the, get in, get out, which I don't think either of those are investing strategies.
I hear you, but like you're at a cocktail party, someone's like, Lizanne, why should I own stocks at all when I can own longer dated treasuries, I can reduce my risk, or I can own money market funds? Fed just raised interest rates, right? So I'm getting even more bang for my buck there, and I just can sleep. I can sleep at night. How do you counter that?
Well, it depends on what the goals are of the investor. If 4% or so with the sleep at night factor is enough in terms of the generation of income along the way, and they don't need to grow principal to a significant degree, then yeah. But I don't think that there's a cookie cutter blanket answer to a question like that. It depends on what the goals are of the investor, and a long-term investor that's looking to grow the principal and not just generate some income probably is going to want to have equity exposure. I just think this is an environment now within the equity exposure that you want to be really quality focused, and then also apply the disciplines around diversification and periodic rebalancing.
Do you think the Fed was hawkish today? Was Powell hawkish? Was it more so than you expected? How would you characterize what he said and what they did?
Well, I think probably the most important thing was what Powell did not say, which, by the way, I think is appropriate, which is he did not reinforce what the market has expected, which is rate cuts starting in short order. I have felt that that's quite an odd disconnect that's still embedded in market expectations, with inflation still above the Fed's target, a still tight labor market without serious deterioration being witnessed either in the economy or specifically employment. How that is supportive of a pivot just doesn't make any sense. All of that may be supportive of a pause as the Fed assesses the effects of what they've already done. But this notion of all else equal with inflation still well above the target, that there's some justification for a pivot, I think the Fed is dealing with a bit of a credibility issue. I think you would really, really test that credibility if they said, now we're kind of throwing everything away. I think the only way the Fed pivots to rate cuts, not just pauses, is either we get more significant deterioration in the economy, specifically the labor market, or the banking system travails turn into much more of a systemic crisis. Absent those two, or some combination, take the Fed at their word, which is their inclination is, even if they're now at the terminal rate, they're going to stay there for a while.
Do you worry about more banking issues? I mean, the Fed chair, I thought it was, interesting today where he used those words, sound and resilient, that conditions have broadly improved. To many people, it would be, I don't know, the opposite.
Well, I guess it depends on whether those comments were tied to what Powell and others on the FOMC saw in their advanced look of the SLOOS report, which comes out next week. And he did reference that. But we have to remember that credit conditions, even in advance of the start of this banking system problem with the fall of SVB, credit conditions based on the prior quarterly SLOOS report showed tightened conditions in recession territory already. And it does raise the risk of not just a credit contraction, but a credit crunch. That doesn't tend to happen sort of moment in time. But I think that's the way to think about the economy on a looking forward basis is how severe is the tightening in credit. So even if this doesn't continue to be sort of the whack-a-mole of individual banks under pressure, I think the broader force of a potential credit crunch and the impact that has on the economy is definitely still ahead of us.